Most traders think stress comes from the market. They think it's the news, the candles, the red and green flashes on the screen. But I learned long ago it isn't the market that makes you nervous. It's the position you took. You ever notice that when you're in a trade that fits your plan, you sleep better, even if price wiggles? But when you chase something, even a small dip feels like a knife in your stomach, doesn't it? That's the first truth of holding trades without stress. You don't hold price, you hold correctness. When you are right, time becomes your friend. When you are wrong, every minute feels heavy. I used to watch the tape like a hawk watches a field. The price didn't talk, but it whispered. If you were calm enough, it told you when it was healthy and when it was sick. Stress comes when you enter before the market finishes speaking. You jump in while it's still arguing with itself, and then you wonder why it keeps going against you. Tell me, how many times have you bought just because price moved fast, not because it built a base? That's not trading. That's grabbing at shadows. A trade that can be held without stress is one that comes from structure. It breaks out of a range. It pulls back clean. It holds above old resistance. When you buy there, you're not guessing. You're agreeing with the market. An agreement is peaceful. Most people want excitement. They want a big green candle. But excitement is the enemy of holding. The right trades feel boring at the start. They move slow, they breathe, they don't jump around. But inside that quiet movement is power building. You don't need to stare at every tick when you're in a proper position. You already did the hard work before you entered. You waited for price to tell you the story. So now you let it finish the sentence. You ever see a stock break out, pull back gently, then start climbing again like a man walking up a hill? That's not stress. That's rhythm. The reason most traders can't hold is because they never truly believed in the trade in the first place. They just hoped. Hope is noisy. Belief is quiet. When I was younger, I'd take profits too fast. I'd see a few points and grab them like a scared man. But later I learned something. The big money isn't in being right. It's in staying right. You don't make your fortune by buying. You make it by holding while others shake themselves out. Now tell me, do you exit because the chart broke, or because your emotions did? There's a big difference. A clean trend doesn't go straight. It zigzags. It breathes. If you don't know that, every pullback feels like a threat. But if you've studied trends, you know pullbacks are the market resting before the next push. So when price dips a little after you enter, you don't panic. You check one thing. Did the structure break? If it didn't, then nothing changed. Stress comes from watching price without context. A man who knows where support lies doesn't fear a dip. A man who doesn't sells the bottom and calls it bad luck. Holding a trade is easy when you accept one thing. You will never get the top. You will never sell perfectly. The goal isn't perfection. It's participation in the move that matters. That's how wealth is built in trading. Not by jumping in and out like a nervous gambler, but by sitting tight while the trend does the heavy lifting. I used to say the market pays you for being patient. But really, it pays you for being prepared. You draw your levels. You mark your ranges. You wait for price to step out of line and show its hand. Then you take your position. And now the work is mostly done. Why would you be stressed after that? You already accepted your risk before you entered. You already decided where you are wrong. So what is there to fear now? The market can only do one of two things. Prove you right or prove you wrong. Either way, you're free. Most traders never accept being wrong. That's why they stare at every candle like it owes them something. You don't need to be glued to the screen to hold. You need clarity. When your stop is in the right place, the noise in between doesn't matter. Think about it. A man who bought a stock at the start of a major uptrend doesn't care about every penny it wiggles. He cares about whether the trend is still alive. Are you trading pennies or trends? There's a big difference in how that feels. I've seen markets roar and collapse. The ones who made real money weren't the smartest. They were the calmest. They didn't fight the tape. They didn't argue with price. They simply stayed in their seat while the train moved. Stress comes from fighting reality. When you buy a breakout and price retests it, that's not danger. That's confirmation. The market is checking its footing. If it holds, it's telling you, this move is real. If you didn't know that, you'd sell. And then you'd watch it run without you. Holding without stress also comes from position size. If you're too big, every tick feels like a punch. But if you're sized right, you can think clearly. The market rewards calm thinking. Panic clouds judgment. Ask yourself, is your position small enough that you can let the chart work? If it isn't, you're not trading. You're sweating. The irony is the trade you barely think about is usually the one that makes the most. You entered it right, you sized it right, and now you let it grow like a tree. You don't dig up a seed every day to see if it's sprouting. So why do traders dig up their positions? They don't trust their analysis. They don't trust their preparation. They don't trust themselves. But the market doesn't need your trust. It needs your discipline. When you hold a good trade, you're not being lazy. You're being professional. You're allowing probability to do its work. You can't force a chart to move faster. All you can do is not get in its way. That's what stressless holding really is, staying out of your own way. And as price moves in your favor, something interesting happens. Your fear fades. Your confidence grows. You stop checking every minute. You start thinking in terms of days, even weeks. That's when trading stops feeling like gambling and starts feeling like business. You begin to think in campaigns, not skirmishes. And then you realize something most never do. The real battle was never with the market. It was with your need to be right, your need to be in control, your need to do something when doing nothing was the smarter move. Tell me, how often has doing nothing made you more money than doing something? The chart doesn't care about your impatience. It moves when it's ready. And when it moves, it pays the ones who were already in, not the ones who chased after it. That's why stressless holding is really about timing your entry so well that holding becomes natural. When you buy late, holding is torture. When you buy right, holding feels almost obvious. And as the trend unfolds, you start to see the market in a different way. You're no longer reacting to every wiggle. You're watching the slope of the move, the character of the pullbacks, the way volume behaves as price rises. You're listening again. Strong trends make holding feel easy because when a market is truly moving with purpose, it stops arguing with itself. You can see it on the chart even before you feel it in your gut. The candles stop whipping back and forth, and instead they start stepping in one direction, one push after another, with small pauses in between. That kind of movement isn't loud, it's steady, and steady movement is what gives a trader peace. You don't need to guess what will happen next when the market keeps showing you the same thing over and over again. You just follow what it is already doing. That's why a strong trend feels like being carried by a current instead of swimming against waves. When you enter a trade that lines up with a real trend, the market starts doing the work for you. You are no longer trying to force a move out of nothing. The trend is already there, already alive, already pulling price forward. Your job becomes simple. You stay in as long as the trend stays intact. That simplicity removes the constant mental noise that wears traders down. You are not watching every tick with fear, because you know the big picture is still pointing the same way. Even when price pulls back a little, it does not feel threatening, because you understand that trends breathe. They move forward, then they rest, then they move again. A strong trend creates higher highs and higher lows in an up move, or lower highs and lower lows in a down move, and that pattern becomes your anchor. Each time price pulls back and then turns again in the direction of the trend, it is confirming that the larger move is still in control. That confirmation builds trust. And trust is what makes holding a position feel natural instead of stressful. You are not hoping anymore. You are observing. You are seeing the same structure repeat itself on the chart, and repetition builds confidence. Most of the stress traders feel comes from trading markets that are not trending. In choppy, sideways conditions, price moves without commitment. It goes up, then down, then up again, without ever going anywhere. In those environments, holding feels painful because nothing is clear. Every candle feels like a threat because there is no dominant direction. But when a trend is strong, the market has chosen a side. It is either being bought or being sold consistently. That choice creates momentum, and momentum smooths out the ride. In a strong trend, even bad news often fails to stop the move. You might see a sudden drop or spike, but then price quickly returns to the direction it was already going. That tells you something important about who is in control. When big players are committed to a direction, they use pullbacks as opportunities, not as exits. Seeing that behavior on the chart reinforces the idea that the trend is real, and when you believe in the trend, holding becomes less of a battle and more of a decision to simply not interfere. Another reason strong trends make holding easy is that they stretch farther than most people expect. When a market is truly trending, it keeps moving until something major changes. Traders who jump out early because they are afraid miss the real profit, but traders who understand the nature of trends allow them to unfold. They don't need to predict where it will end. They just ride it until the chart tells them it is weakening. That approach removes a huge amount of emotional pressure. You are no longer trying to pick the perfect exit. You are just following the trend until it shows signs of exhaustion. The structure of a trend also gives you clear reference points. You can place stops under swing lows in an uptrend or above swing highs in a downtrend. That means you always know where you are wrong. Knowing where you are wrong is what gives you freedom. When your risk is defined, you don't have to worry about every small move. You already decided how much you were willing to lose if the trend failed. As long as price stays above or below those key levels, you remain in the trade with a calm mind. Strong trends also tend to attract more traders over time. As price keeps moving, more people notice it. That creates a kind of feedback loop where new buyers or sellers keep entering, pushing the trend even further. This added participation increases liquidity and keeps the movement smooth. Smooth movement is easy to hold. It does not shock you. It does not jerk your emotions around. It simply continues. When you are in a strong trend, you can also step back from the smaller time frames. You don't need to watch every 5-minute candle when the daily or weekly chart is clearly trending. That shift in perspective alone reduces stress. You stop reacting to noise and start paying attention to the bigger picture. The bigger picture moves slower, and slower movement is easier for the mind to handle. There is also a psychological shift that happens when you are aligned with a strong trend. You stop feeling like you are fighting the market. You feel like you are cooperating with it. That changes your entire experience. Instead of constantly asking yourself if you should get out, you start asking if there is any real reason to stay in. Most of the time, the answer is no, because the trend is still doing what it has been doing. Over time, traders who learn to recognize and trust strong trends begin to develop a different relationship with risk. They are no longer afraid of holding positions for longer periods. They understand that the biggest gains come from staying in while the trend does its work. They see that the market is capable of much larger moves than their fears suggest, and that understanding allows them to sit through normal pullbacks without panic. As you spend more time watching strong trends, you start to notice how similar they look across different markets and time frames. The patterns repeat. The behavior is consistent. That consistency builds a kind of quiet confidence. You don't feel the need to constantly adjust or interfere. You let the market express itself, and you simply stay aligned with that expression. And when you are aligned with a strong trend, the act of holding no longer feels like waiting in uncertainty. It feels like standing on solid ground while the landscape moves beneath you, knowing that as long as the ground remains firm, there is no real reason to step away from it, because the very strength of the trend is what keeps carrying the trade forward through every small pullback and every brief pause, showing you again and again that direction is still intact and that the path you are on has not yet changed. Planning the exit reduces fear, because uncertainty is what really scares a trader, not loss itself. When you enter a trade without knowing where you will get out, your mind stays trapped in question mode. Every candle that forms brings a new wave of doubt. Should I take profit now? Should I hold? What if it reverses? That kind of thinking drains you, and it usually leads to bad decisions. But when you plan the exit before you ever click the buy or sell button, something changes. You already know what must happen for you to be wrong, and you already know where you will take money off the table if you are right. That knowledge creates a quiet kind of confidence that follows you through the trade. A planned exit turns the trade into a simple story with a beginning and an end. You enter at a level that makes sense. You place a stop where the idea is proven wrong, and you choose a target or a trailing method that fits the structure of the chart. Now the market is no longer something you have to negotiate with every minute. It either moves toward your target or it moves toward your stop. Everything in between is just noise. Without that plan, every small movement feels important, and that is what creates emotional pressure. Fear grows in empty space. When there is no exit plan, the space between entry and outcome feels wide and dangerous. You don't know what you will do when price moves against you or in your favor, so your mind fills that gap with worry. You start imagining worst-case scenarios. You see profits disappear in your head before they even exist. But when you have a clear exit mapped out, that empty space shrinks. You already decided how much you are willing to lose and how you intend to win. That decision protects you from your own fear. A good exit plan is not about predicting the exact top or bottom. It is about defining the point where the trade no longer makes sense. If you bought because a stock broke out above resistance, then the logical place to be wrong is below that old resistance. If price falls back under it and stays there, the story you believed in is no longer true. Knowing that keeps you from arguing with the market. You are not exiting because you feel scared. You are exiting because the chart told you the condition you needed is gone. The same is true for taking profits. When you know where the next resistance or support level is, you can decide in advance how you will handle price when it gets there. Maybe you plan to take partial profits. Maybe you trail your stop. Maybe you let it run. Whatever you choose, making the choice ahead of time prevents you from being overwhelmed in the moment. The market moves fast, and emotions move even faster. A plan slows everything down. Traders without exit plans often become prisoners of their screens. They feel like they have to watch every tick because any movement could mean something. That constant attention creates tension. But when you know where your stop and target are, you don't need to monitor every fluctuation. You can step back and let the trade work. That distance is healthy. It gives your mind room to stay calm. There is also a kind of honesty that comes with planning exits. You are forced to face the risk before you take it. You cannot pretend the trade is perfect. You have to admit where it could fail. That honesty builds discipline. It stops you from taking trades that are too risky or poorly structured, because you can see clearly what you are putting on the line. Over time, this habit changes the way you see the market. You stop thinking in terms of winning or losing and start thinking in terms of executing a plan. Each trade becomes just one event in a long series. When you know your exit, a single trade no longer carries so much emotional weight. It is just another opportunity to follow your rules. Fear thrives when you feel out of control. Planning the exit gives you back control. You are no longer reacting to whatever the market throws at you. You are responding according to a decision you made when you were calm. That calm decision is more reliable than any impulse you will have while the trade is moving. A trader who plans exits also learns to accept losses more easily. When you get stopped out according to your plan, it does not feel like failure. It feels like the market simply did not do what you expected. That acceptance keeps you from revenge trading or forcing the next setup. You stay grounded. The same thing happens with profits. When you reach a planned target, taking money off the table feels natural. You are not second guessing yourself. You are not wondering if you left money on the table. You are simply doing what you said you would do. That consistency builds trust in yourself. Trust in yourself reduces fear more than anything else. When you trust that you will follow your own rules, you no longer feel like you are at the mercy of the market. You feel prepared. And that preparation makes it easier to sit through the normal ups and downs of a trade. The chart can move. Your plan stays. That is what keeps your mind steady. That is what keeps your hands still. That is what lets the trade play out. Structure matters more than speed, because the market is not a race, even though it often feels like one. Price can move fast, and when it does, it pulls on a trader's emotions like a strong wind. You see a candle shoot up or down, and your first instinct is to chase it, to jump in before you miss out. But fast movement without structure is just noise. It can go anywhere, and it often goes nowhere after it finishes its burst. What gives a move real meaning is not how quickly it happens, but how it is built. When a market is structured, it leaves footprints. You see ranges form. You see support and resistance develop. You see price test certain levels and react to them. Those reactions tell a story. They show you where buyers are willing to step in and where sellers are willing to defend. That story is what you trade. Speed alone tells you nothing. A fast move might look exciting, but without structure behind it, you have no idea if it will continue or collapse. Traders who focus on speed often feel like they are always late. They see a big move and think they missed it. That feeling pushes them to chase the next one. But when you understand structure, you realize that every real move starts slowly. It builds a base. It shakes out weak hands. It gathers energy. By the time it moves fast, the best opportunity is often already gone. The calm part, the boring part, is where the smart money positions itself. Structure gives you a framework to make decisions. If you know where support is, you know where the market should not go if the trend is healthy. If you know where resistance is, you know where price might pause or reverse. These levels act like signposts. They keep you oriented. Without them, you are just reacting to motion, and reaction is stressful. Speed, on the other hand, creates urgency. Urgency makes you impulsive. It makes you ignore your rules. You start thinking in seconds instead of in patterns. That is when mistakes happen. A trader who waits for structure is slower to enter, but more confident once they are in. That confidence comes from knowing that their trade is based on something real, not just a burst of activity. When you look at a chart with structure in mind, you are not impressed by a single candle. You are interested in how price behaves around key levels. Does it hold above a breakout? Does it reject a support? Does it form higher lows? Those are the clues that tell you whether a move has strength. A fast candle might catch your eye, but a well-formed pattern earns your trust. This is why structure makes holding trades easier. When you enter based on structure, you know what should happen next if the trade is working. You know what a healthy pullback looks like. You know where price can go without breaking the pattern. That knowledge allows you to stay in during small fluctuations. If you entered on speed alone, every slowdown feels like a warning. You have nothing to lean on. Markets that move fast but lack structure often reverse just as quickly. They leave traders confused and frustrated, but markets that move with structure tend to trend. They move in waves, creating opportunities to enter, add, and hold. That rhythm is what long-term profits are built on. Structure also keeps you aligned with the larger players. Big institutions cannot move in and out of positions in seconds. They need time. They need liquidity. They build positions slowly, often within ranges or during pullbacks. When you trade structure, you are trading in the same areas they are active. When you chase speed, you are usually trading against them. Understanding structure changes how you see the chart. You stop seeing random lines and start seeing zones of interest. You see where battles have been fought before. You see where price has memory. That memory is what creates opportunity. Speed has no memory. It is gone as quickly as it arrives. There is also a psychological benefit to focusing on structure. It forces you to slow down. You wait for setups. You let patterns form. That waiting builds discipline. Discipline builds consistency. Consistency builds confidence. Speed builds none of these things. When you enter a trade based on a clear pattern, you feel grounded. You know why you are in the trade. You know what invalidates it. That clarity removes a lot of fear. You are not guessing. You are following a plan built on what the market has already shown you. Speed tempts you to abandon that plan. A fast move can make you feel like you need to act now or never. but the market will always give you another opportunity if you are patient enough to wait for structure. There will always be another range, another pullback, another breakout. Structure is what turns chaos into something readable. It is what allows you to see order in what looks like randomness. Without it, trading becomes exhausting. With it, trading becomes methodical. You begin to trust what you see. You begin to trust your levels. You begin to trust your process. And that trust makes holding easier. It makes waiting easier. It makes letting the trade work easier. The market may move fast, but you do not have to. Structure gives you permission to stay calm. Structure gives you something solid to stand on. Structure keeps you from being swept away. Letting winners run builds accounts, because most of the money in trading does not come from being right often. It comes from being right big. Many traders focus on how many winning trades they have, but that number does not tell the real story. What matters is how much you make when you win compared to how much you lose when you are wrong. When you cut your winners short, you limit the very thing that is supposed to pay for all the small losses along the way. A trader who learns to let strong trades continue is allowing the natural edge of the market to work in their favor. The market moves in bursts. It spends a lot of time going nowhere, then suddenly it trends. Those trending phases are where most of the profit is created. If you take your money off the table as soon as a trade starts to work, you are stepping away just when the real opportunity begins. That habit feels safe in the moment, but over time it keeps your account small. You may have many little wins, but you never catch the moves that can truly change your equity curve. There is a deep emotional reason why traders cut winners early. When you see a profit on the screen, it feels fragile. You imagine it disappearing. That fear pushes you to lock it in as quickly as possible. But that fear is not based on the chart. It is based on your past experiences and your discomfort with uncertainty. The chart might be showing strength, higher highs, healthy pullbacks, and steady momentum, but your mind is focused on protecting what you already have instead of on what the trade could become. Letting winners run requires trust in the trend. If you bought a breakout and price keeps holding above that breakout, there is no logical reason to exit just because you are in profit. The trade is doing exactly what you wanted it to do. Exiting early turns a good trade into an average one. Over hundreds of trades, the difference adds up to a large amount of money. When you allow a trade to continue, you give it room to surprise you. Markets often go much farther than people expect. A stock that looks extended on a small time frame can still be in the early stages of a major move on a larger one. If you are only focused on grabbing a few points, you miss the possibility of catching a trend that lasts for weeks or months. The key to letting winners run without losing control is having a method for managing the position. This might be a trailing stop, a moving average, or a series of higher lows. Whatever you choose, it should be something that keeps you in the trade as long as the trend is intact. That way you are not just holding blindly. You are holding with structure. This approach also changes how you experience losing trades. When you know that your winners have the potential to be large, small losses do not bother you as much. You understand that a few small losses are simply the cost of finding the next big move. That perspective keeps you from becoming discouraged. You are not trying to avoid losses. You are trying to make sure that when you win enough to cover them and more. Accounts grow when a handful of trades do most of the work. That is the reality of trading. You might take dozens of trades in a month, but only a few of them will be the kind that really matter. If you are not in those trades long enough, you will never see the impact they could have had. You will look back and realize you were right, but you did not stay long enough to benefit. Letting winners run also trains your mind to think in terms of trends instead of in terms of quick hits. You start to look for trades that have the potential to go far, not just ones that might give you a small profit. That shift in thinking improves the quality of your setups. You become more selective. You wait for markets that are showing real strength or weakness, not just temporary movement. There is also a compounding effect to this approach. When you catch a big move and your account grows, your future trades are larger. That means the next big move has an even greater impact. Over time, this creates a curve that can accelerate upward. But that only happens if you let the market give you what it is capable of giving. Many traders sabotage this process by taking profits too quickly because they want to feel successful. They want the emotional reward of a win. But trading is not about emotional rewards. It is about building equity. The market does not care how you feel. It responds to patience and discipline. When you hold a winning trade through its normal ups and downs, you build emotional strength. You get used to seeing open profit fluctuate. You stop panicking every time the market pulls back a little. That emotional stability is what allows you to stay in the trade long enough for it to reach its full potential. The irony is that letting winners run often feels harder than cutting losses. Cutting a loss is a clear action. Letting a winner continue requires you to do nothing while money is on the line. That can be uncomfortable. But that discomfort is where growth happens.